Hello and welcome to mymoneykarma's video series on intelligent personal finance. If you're a youngster just starting your career, here's the single biggest thing you can do right now. Start building a solid credit history. Some of you may not have heard about credit score at all, or maybe you've got a rough idea but don't know exactly what's going on. Doesn't matter, that's what this video is for. In this video, we'll be answering the following questions. What is a credit score? Why is it important? What factors influence it? How can you build it? How can you improve a low credit score? How can you maintain it over time? And what are the mistakes to be avoided? Before we get into it, here's the deal. If you want 100% sure that you're never going to need a loan or a credit card, then by all means go ahead and skip this video. You'll be fine. But if that's not the case, then you better stick around. Remember, a loan comes in many subtle forms. Just click the EMI button on Amazon, you just became a borrower. In developed markets like the US, your credit score is not only used by lenders, but also others like landlords, utility companies, and even employers. That future isn't far away in India. So let's go ahead and get you up to speed. Generally, your credit score is a number ranging between 300 and 900. This score shows your credit worthiness, or how worthy you are of getting loans and credit cards. Your credit score and credit report are like your marks percentage and your progress report in school. Even though your marks percentage gives a good idea of how well you're doing, the percentage itself is found inside the progress report, which is a lot more comprehensive. The report has remarks on pretty much all your activities as a student. Have you been missing classes? Have you been making submissions on time? Likewise, your credit score is a number that shows how well you're doing in credit, and it can be found inside your credit report, which has details of all your credit activities, loan applications, repayment history, missed payments. If you make mistakes, there can even be negative remarks in there. Your credit report shows why exactly your credit score is where it is, so that you can make the needed improvements. So who calculates your credit score? Credit scores are calculated by entities called credit bureaus. That's just what they do. Coke Studio makes good music, and credit bureaus calculate your credit score. They take into consideration a number of factors: your credit history, credit inquiries, your repayment track record, and even your Netflix watch list. Actually, that's not true, but the rest of it is. Going with the previous example of progress reports, the credit bureau would be like your class teacher, and the lenders, all the other teachers. The bureau collects your information from all the other lenders and compiles it in your credit report, which also contains your credit score. But thank God your parents don't have to sign on it. Here's the thing. Many of us just assume that we can walk into a bank if we want a loan or credit card, and the bank will agree just like that. After all, the bank has the money, you need the money, and you're willing to pay interest. Why should the bank even hesitate? But in truth, walking into a bank without a credit score is like trying to go abroad without a passport. Here's a scenario. If you're hiring a car mechanic, would you rather have someone whose cars run good as new, or someone who has a history of his cars breaking down soon after repair? Even if he promises that he'll fix your car up properly. What about someone who's only ever repaired one car before? Or someone who's been rejected by 10 car owners just before you? Likewise, the lender needs to be sure that lending you money is the right decision. They need some sort of assurance that you will repay them on time. Otherwise, it's just a bad investment. And that's where your credit score comes in. Banks and other lenders depend on your credit score and your detailed credit report whenever you apply for a loan or a credit card. The credit score helps them decide not only whether to approve your loan or not, but also what interest they should charge you. A lower than ideal credit score also means high interest rates. A few tens of points on your credit score would actually save you lakhs in interest. Moreover, with a good credit score, your approvals are smooth, timely, and reliable. You could also have large credit limits. This helps you build your credit score further, thereby setting up a virtuous cycle. So we all agree that's where we need to be. Let's figure out how by first analyzing the factors that influence your credit score. There are 5 main factors that affect a credit score. Let's look at them one by one. First one is payment history. Quite obviously, this is by far the most important aspect that credit bureaus consider. Are you paying on time? No? Are there missed payments, delayed payments, or worst of all, delinquencies? Of course, of all the above scenarios, only the first one is good, paying on time. All the others are just different degrees of bad. Credit utilization refers to the percentage of the available credit limit that you're using. The more the amount you owe lenders, the less likely you are to get loans. Credit history is a measure of your experience in credit. A long history makes you an ideal borrower in the eyes of a lender, just like a lengthy portfolio makes you an asset in the eyes of an employer. Types of credit or credit mix refers to the mix of various loan instruments that you have. Lenders like to see more variety in your credit report. For instance, home loans, personal loans, and credit cards, each of which gives a more rounded picture of your credit experience. New credit refers to the loans and credit cards that you've recently applied for, having more of which is not seen well by lenders. They begin to wonder if you're suddenly taking up too much liability unsustainably. But all this matters only assuming that you even have a credit score in the first place. If you don't have a credit history, then you don't have a credit score either. Not having a credit score is no reason to panic. You can start building your credit score and history right from today. Yes, it will take some time. Don't expect to get anywhere near 800 very soon. Look at it as a marathon, not a sprint. The pace is easy, the habit is simple, only the course is long. Let's see how it's done. 1. Apply for a credit card. Most lenders are unlikely to give you any credit without a credit history. In other words, to build credit, you need to use credit. But if no one gives you credit, how do you build it? Quite confusing, isn't it? The good news is that you can start your credit journey by just getting and using a credit card, which is made easily available to most people. 2. Become an authorized user on someone else's credit card. Yes, you can actually do so. Just be careful with this one. Wrong usage on anyone's part affects not only the cardholder, but you too. 3. Use your credit cards intelligently. Remember, your credit card serves you, not the other way around. Use your credit card regularly so that you can build a track record of on-time payments to enhance your credit history. Make sure that you don't end up having outstanding amounts, maxing out on your credit limit, or taking out other loans. 4. Explore credit building loans. Some lenders offer loans designed specifically to help you build your credit as a first-time borrower. A student loan could be a good example of this. Find an option that is best suited to your circumstances, and it's likely that you can use a small loan to get started on your credit journey. And that's it. If you follow these tips, no one can stop you from building your credit score to a respectable level. And after that, the sky's the limit. At least a score of 900 anyway. And all it requires is a simple credit improvement strategy. Think of your credit score as a plant. After you water your plant for months and years, it is at the end that you get to see the results of your hard labor. Just as a small plant grows into a tree one day, so too can your small credit score reach 800 and above. So what is this earth-shattering strategy? An elaborate 20-step plan? No, just one. Pay your bills and loans on time. As simple as that. But it isn't as easy as it sounds. So here are a few tips to help you out. 1. Be disciplined with your credit. Set reminders if you have to. 2. Maintain your credit cards to lengthen your credit history. 3. Customize your credit limit based on your expenses. 4. Pick longer loan tenures. 5. Don't take or apply for too many loans at once. 6. Regularly check for mistakes in your credit report to rectify them. 7. Choose various forms of credit and develop a better credit mix. Maybe you have improved your credit score to a respectable degree now. 800 perhaps. If so, congratulations. But don't slack off just yet. A bad move right now could make your credit score drop. As your credit habits evolve, the pitfalls evolve as well. From a simple credit card, we tend to take on larger responsibilities, like a home loan, for instance. These are often inevitable and bring with them larger obligations. The biggest mistake we see our customers make is that once they build their credit score, they forget about it. The intelligent way to handle your personal finances is to stay on top of your credit report at all times. That way you get to catch misinformation, miscalculations, and sometimes even identity fraud. Mostly, you build good discipline, which is at the heart of every good credit score. This ensures that your credit score is right where you want it to be when you need it the most. Remember, just because you have a 50 lakh home loan doesn't mean that your missed payment on a 5,000 rupee credit card bill will be swept under the carpet. To avoid any such mishaps, here are some common mistakes that you need to avoid. Some are very obvious, others less. 1. Not staying on top of your EMI payments. We can't stress this enough because it is the single biggest reason that your credit score could fall, and yet many let it happen all too easily. When you do this, not only does your credit suffer, but you can also get slapped with penalties by your lender. 2. Having your account sent to collections. If you don't pay your loan at all, then your loan account is sent to collections. You'd be surprised at how many people believe they'd escape their liabilities this way. But delinquency hits your score hard, and it remains on your credit report for many years. So it's better never to go down that route. 3. Closing your old credit card accounts when your credit balance is already maxed out. You can't spend beyond your credit card limit. Maxing out on your credit limit is already bad enough. And if you close an old credit card on top of it, the consequences of it are twofold. This results in an increase in credit utilization on your report, and it also decreases your credit history or credit age. Both contribute to a drop in your score. Altogether, this is not a good move at all. In this video, we have learned what a credit score is, where it is used, and the steps you can take to proactively analyze and utilize it to manage your finances intelligently. Now that you understand the basics, I recommend that you dig a little deeper into reading your credit report well or understanding the difference between hard and soft inquiries. Do you have any specific topic that you'd like to learn about? Or is there anything at all related to finance that you'd like to know or you're a little confused about? Leave a comment below and we'll get to it. Also, make sure you subscribe to our channel so that you don't miss out on our complete series on intelligent personal finance.